Hello, and thank you for joining us for the first quarter market update. My name is Jason Gunkel, and I lead our investment team here at Syverson Strege. I hope you have been enjoying March Madness so far, and there's been good reason to enjoy it with both Iowa and Iowa State doing well. But unfortunately, there's been a little madness in the markets during March as well. Overall, it was a challenging quarter across most asset classes. The U.S. stock market declined about 5%. International developed stocks were down 0.6%. Emerging market stocks were a bright spot, gaining 3.5%. Global real estate, or REITs, were modestly positive at 0.7%. And on the fixed income side, U.S. taxable bonds declined close to 1%, and municipal bonds were down about 0.5%. We are recording this a couple of days before the end of the quarter, so these numbers could change a bit. The market started the year relatively strong, but following U.S. and Israel attacks on Iran in late February, we saw a noticeable shift in market sentiment. The U.S. market fell about 9% from peak to trough year to date, and international market saw a similar reversal, moving from nearly double-digit gains earlier in the quarter to slightly negative returns by quarter end. The areas that led the market higher last year, particularly large growth and technology stocks, have been hit the hardest. Large growth stocks are down about 11%, and that is largely due to technology stocks being down close to 10%. The Magnificent Seven stocks that make up nearly 40% of the S&P 500 index are down roughly 17.5% on average year to date. Technology stocks entered the year with the highest valuations, and there are still questions around how quickly companies will see returns on their significant investments in artificial intelligence. So it is not a big surprise that they have had the worst returns this year. At the same time, other areas of the market have held up much better. Value and small cap stocks have outperformed. Small cap value stocks are still up about 5% year to date. One of the key ways that the Iran conflict is impacting the market is through energy prices. Oil prices moved sharply higher, reaching over $100 per barrel. That raised concerns about rising costs across the global economy and the potential for renewed inflation pressure. As a result, interest rates also moved higher as markets adjusted expectations for Federal Reserve policy. And when rates rise, bond prices fall, which helps explain why we saw slightly negative returns in both taxable and municipal bonds this quarter. When we look ahead, market expectations for interest rates have shifted meaningfully. Based on current probabilities, the market now expects the Federal Reserve to largely hold rates steady this year, even with more possibility of rate hikes and very little expectations of further rate cuts. That's a significant change from where expectations were coming into the year and reinforces the idea that interest rates may remain higher for longer. This largely depends on how long the conflict with Iran persists. With the recent pullback, valuations have become more attractive. The forward price-to-earnings ratio for the S&P 500 is now around 20, which is much closer to its 10-year historical average. So while markets have declined, that decline has helped bring valuations back to more reasonable levels. One of the most encouraging areas of the market right now continues to be corporate earnings. Earnings for the S&P 500 are expected to grow about 17% year over year, which would mark the third consecutive year of double-digit growth. And while there are still questions about the timing of returns on AI investments, it's very possible that AI continues to support or even enhance profitability over time. While geopolitical events like the current conflict can create uncertainty, it's important to keep them in perspective. Looking back over nearly 100 years of market history, we see that while conflicts often increase short-term volatility, they don't consistently lead to prolonged market declines. In many cases, markets have delivered positive returns in just a few months or years following geopolitical events. It's also important to remember that outcomes are influenced not just by the conflict itself, but by the broader economic environment at the time. It's important to recognize just how difficult it is to predict market returns. If you look at forecasts from a wide range of institutions over the past several years, in 4 out of the last 5 years, actual market returns fell outside of those range of forecasts. In other words, even professional forecasts are often wrong. That's a good reminder that trying to time the market is extremely difficult and why staying focused on a long-term strategy is so important. As we look ahead, there are both positives and risks to consider. On the positive side, we continue to see fiscal support in the economy, strong employment and consumer spending, and solid corporate earnings. On the risk side, there is significant ongoing conflict involving Iran, rising oil prices, and inflation concerns, and the possibility that earnings could fall short of high expectations. In light of all these factors, our portfolio approach remains consistent. We recommend maintaining global diversification, avoiding heavy concentration in technology stocks, and tilting towards value-oriented investments. We also favor higher quality, shorter duration bonds, and importantly, we recommend maintaining enough cash to cover your upcoming expenses so that you're not forced to sell investments during periods of market declines. Thank you for listening today and for your continued trust in us. Our team will continue to monitor the markets and try to keep you informed. Take care, and we hope to see you soon.